Part 4, Options Math. This is by far the most complicated part of the course. If you're not mathematicians or statistics or, I don't know, engineers, then you may find some parts quite hard to understand. If you get lost, just try to catch the main concepts. Because in the end, the goal of this part is just to let you know why put options and call options prices have to follow specific rules in terms of the values, how you can price options without going into too much and complicated details, and the infamous Greeks. Some people cannot live without, some people cannot stand the Greeks. Let me say I'm not very fond of the Greeks, but because for my personal trading style, they are almost totally useless, because my option trading is all for maturities. So in the moment that I purchase or I short sell an option, what I do is always wait for the maturity. And that maturity, as we already know, it's just a matter of intrinsic value. There are no more time, volatility, and nothing else to account for. So I don't need the Greeks in order to understand what could happen to my strategies. And by the way, given a great deal of experience, I've been doing this for almost 20 years now, I can tell you that I don't need the Greeks to know what I can expect during the lifetime of an option I have in my portfolio. I can predict it more or less perfectly. So, upper and lower limits of calls and puts, the put-call parity, some basic statistical concepts, the Black-Scholes formula, the Greeks, and portfolio Greeks. The part about the basic statistical concepts, it's quite important because it is, let me say, a mathematical demonstration that short selling of options is much better than buying of options. So pay a special attention to this part. Lesson 16, upper limits of options prices. Here what you will learn, what can be the maximum price of a call or a put. Premise, the whole mathematics of options is based on the principle of non-arbitrage. Prices must not leave room for any possibility of certain profit without risk. In addition, there are basic assumptions that must be considered. The creditor and the debtor interest rate is the same. There are no limits to short selling and to the use of the related proceeds. There are no margin deposits and marking to market. There are no transaction costs. Option prices are characterized by an upper limit and a lower limit. In the case of a call, the price of the option can never exceed the price of the underlying security, whatever happens. If C is the price of the call and S0 is the current price of the underlying, then we can say that it is always valid, call always lower or at most equal to S0. The validity of the above inequality is easily demonstrated. For example, be 10 euros the spot price. If a call with any strike and any maturity quotes over 10, it would be enough to buy the stock and sell the call to make a certain profit in any case, even if the underlying is zeroed. See examples. In fact, if we consider absurdly the sale of a call strike price 0 at 11 euros, okay? Call strike price 0, short sold for 11 euros. Then we assume that at maturity the underlying is 20. In this case, the underlying purchased for 10 produces a profit of 10. The call strike 0 is in the money and is worth 20. The intrinsic value, but we short sold it for 11, so we lose only 9. So we have a 10 euros profit on the underlying and a 9 euro loss on the call. Therefore, we collect euro in total. There's also the payoff on the next slide. If the regulation is not monetary but physical, at expiry we must sell the security at 0, losing all the investment, 10 euros. but as we keep the premium of the sold call, 11, our net global balance is +1. Now we assume instead that at maturity the underlying is 10. In this case, the underlying purchased at 10 does not produce either a profit or a loss. The call strike 0 is in the money and is worth 10. The intrinsic value, once again, we sold it for 11, we keep 1, so in total we collect 1 also in this case. In the case of physical exercise, once again we sell the shares at 0, losing 10, and we keep the entire premium of the put, 11 euros, and once again the net balance in the end is 1 euro. Finally, we hypothesize that the underlying is zeroed. The company goes bankrupt. The long position on the underlying produces an integral loss of the investment, so a 10 euros loss. The call strike 0 sold at 11 is at the money, so it is valued 0, and the premium of 11 euros is completely collected. Even in the worst case, therefore, one always receives 1 euro. Let's see it on the chart. Combined payoff at maturity of underlying purchase at 10 and the call strike 0 short sold at 11. We have the long underlying at 10. If at maturity we are at 10, we have a parity. If it's above, we have a profit. If it's below, we have a loss. The short call 11, the short call strike 0 for 11 euros would be, the payoff should be an horizontal line up to the strike and then down proportionally to the price movements for any price higher than the strike. But since the stock cannot go below 0, we don't have the horizontal line, we just have the diagonal one, the declining one. So from 11 and from 0 and on, for every euro of price increase of the underlying, we lose 1 euro on the short call. So what happens? If at maturity the underlying is 10, we have a parity on the stock, we have a 1 euro profit on the short call, so the final balance is +1. If the price at maturity, the price of the underlying at maturity is 0, we lose all the 10 euros we paid to purchase the stock, but we keep 11 euros on the short call, so the final balance is still +1. What if at maturity the underlying is 20? We have a long underlying for 10, it is valued 20, so we gain 10. The short call 0 sold for 11 is valued 9, because at maturity the value is 20. We collected 11, we have to restitute 9, we have to pay the difference, 9. So +10 on the stock, -9 on the short call, the final balance is still +1. So the combined payoff, the red line, is +1 no matter what happens to the security. For any strike above 0, it is then easily to demonstrate then that the final profit is equal to 1 only in the worst situation, while in all other cases it is higher. Let's go directly to the next payoff chart. Here we short sell a call strike 1 for 11 euros, a price higher than the spot. Okay, the hypothesis is that the price of the call cannot be higher than the spot, no matter the strike, no matter the maturity. So let's assume that the call price is 11, higher than the spot. If at maturity the spot price is 10, what do we get? We have a parity on the stock and we have +2 on the option. Why? Because the strike is 1, so the value of the option at maturity is spot minus strike, 9. We short sold it for 11, we restitute 9, we keep 2 as a difference. The same applies if the underlying at maturity is 1 euro, because in that moment the option is at the money, so it's worth 0, and we keep all the money collected from the short selling, 11. On the stock, we have a loss of 9, so +11 minus 9 makes +2. The same applies if the stock goes to 20. Let's keep the last value for later. If the underlying at maturity is 20 euros, what do we get? We have a +10 on the underlying. We have minus 8 on the option, because the break-even point is strike plus premium, strike plus premium, so it's 12. So at maturity, if the break-even is for 12, the net loss when the underlying is 20 is minus 8. So we have plus 10, minus 8, always plus 2, the combined payoff, the red line. What if the company goes bankrupt? We lose all the money collected from, we lose all the money invested in the stock, 10 euros. What happens to the call 11? We keep 11 euros because the option is out of the money. So we keep 11, we lose 10, the final balance is plus 1. The conclusion is that if we move the strike of the option above and above and above and above, we will keep a sure profit no matter what for any price equal or higher than the strike. Then we will have a descending profit, but always positive. In the case of a put, on the other hand, the price of the option can never exceed the current value of the strike price, whatever happens. If P is the price of the put, K is the strike, R is the risk-free interest rate, and T is the residual life of the option, then we can state that P is always lower or at most equal to K times exponential function power 2 minus R times T. For example, B10 the price of the underlying. If a put strike 10, any maturity quotes 10, it is sufficient to sell the put short and invest the proceeds at the risk-free rate to obtain a certain profit at zero risk. Suppose in fact at maturity the underlying shares any price equal to or greater than 10. In this case, the put is at or out of the money, therefore it is worth 0. Therefore, all the 10 euros collected by short selling it are kept. And moreover, the money invested at the risk-free rate has produced an additional profit. Therefore, the final result is 10 plus interest. If, on the other hand, the underlying shares falls due below 10, let's say 5 for example, the put is in the money, and what happens depends on the exercise provided for in the contract. If the exercise is physical, the put is exercised, so you have the obligation to buy the underlying for 10. The 10 invested at the risk-free rate become 10 plus interest, and 10 is used to buy the underlying, on which there is a theoretical value of 5. In addition, an amount of money equal to the interest remains in the pocket, so if you sell the stock immediately, collecting 5, and you have a total final balance of 5 plus interest. The same applies also in the case of monetary settlement. The put at maturity is worth 5. Since it was sold for 10, it leaves 5 in our pockets, plus the accrued interest. The net profit decreases as the underlying falls due, but it never falls below the interest, even in the event the price of the underlying is zeroed. In fact, in case of monetary regulation, if the price of the underlying is 0 at maturity, the option is worth 10, then all the collected premium is returned, and the value of the interest on the premium is maintained. If, on the other hand, the settlement takes place with physical exercise, you have the obligation to buy the underlying at 10 and you lose everything. But again, you keep the value of the interest on the premium sold. So far, that's all. Let's now move to lower limits of calls and puts. Thank you for your attention.